What's up, you idiots? Welcome back to another video.
So you want to be a millionaire? Well, first let's go to Wall Street Bets and figure out what they're doing to get the insider information that we're all looking for. Click the first post about Tesla call options and then do the exact opposite of this person because they're a low-life degenerate who isn't going anywhere in life. On a serious note, if you want to make money in the stock market, I'm going to show you how to do it in this video.
Make sure you go ahead and hit that subscribe button. Let's get right into it. Making money in the stock market is directly related to your ability to weigh the probabilities of different outcomes. It involves evaluating different variables and determining the impact that it will have on price. The combination of all of these variables helps us determine the most likely outcome. And if we know what is more than likely to happen, we can develop a trading strategy to capture the greatest return given our risk appetite. I want to highlight three important dimensions that all traders must understand before making a trade. The three dimensions are price, time, and volume. For a profitable trade, we must know the price of an asset, where the price is headed, and by what time. If you're trading shares, you'll likely care less about time because you can hold the shares until it hits your price target. But for those who are trading options, it is extremely important because your options contract could expire worthless if it doesn't reach your price target by the expiration date. I can't underline this enough that choosing the correct contract that is X strike price away from the current price S and by T time is arguably the most essential skill to becoming a consistent and profitable trader. The third dimension, volume, is often overlooked. It measures the number of shares traded during a particular time period and at what price. These are areas in the price structure where more participants are willing to do business. This creates areas of price support and price resistance. Combining all three dimensions creates the basic framework for understanding what is called technical analysis. It is the method by which traders identify trading opportunities from price trends and patterns seen on charts. Now, if you've watched 99% of other trading YouTubers, you've probably fallen victim to overblown chart patterns and technical indicators. These people think they're the modern day Picasso, drawing the most outrageous patterns and setups that look like they're from third grade art class. These people think they're cracked, but nobody's really buying that knockoff Banksy piece. It belongs in the trash can, just like their year-to-date portfolio. I would highly recommend staying away from overcomplicating your charts. Now for the rest of this video, I'm going to show you where the market is currently at today, what are the probabilities of certain outcomes based on key calendar dates, important economic metrics, and passive market mechanisms, but more importantly, I'm going to show you the anatomy of how I would set up a trade using proper risk management. I'm going to give you potential trades that I may or may not be entering into. Now, as a disclaimer, this isn't investment advice. It's only my personal opinion, and you should always do your own research before making a trade. Now, I hope that in the remainder of this video, you'll have a better sense of how to become a better trader using a rules-based approach where you can minimize your risk and achieve the greatest possible return within your own risk profile. Let's get right into it. First, we'll start off with the overall broader market. We'll cover the main four indices. That's the Dow, the S&P 500, the Russell, and the NASDAQ. And then we'll look at individual stocks. A lot just recently happened with Tesla with their dog AI event, as well as their less than expected delivery numbers just came out, around 14,000 miss there on deliveries. And then we'll look at a trade update for RIVN. We also entered into Royal Caribbean puts, which played out nicely on Carnival's really bad earnings. And then we'll also cover Google, Apple, Enphase, Gamestop, Costco, Datadog, and GOGO. First, starting off with the Dow Jones Industrial Average, you can see here that we did have that sell-off starting in mid-August, and we actually broke below June lows over the last week here, which is really bearish. Now, we talked a lot about volume. If you want to add a volume profile to your chart, you can go to indicators, search for volume profile, select this one here, and it'll add it to your chart. If you go here into the settings, you can have a look back depth. Right now it's only looking back 200 trading days. I like to look back a little bit further just to get a better understanding. Length multiplier, just make the bars a little bit longer. And then we can offset it to the right. And there you have it. You can see here that the point of control is the orange line, where the most volume node is at what price. And you can see here that we actually bounced off the pre-COVID highs back in February of 2020. That acted as support, and then we went all the way back up to retest this node here that acted as resistance, and then we sold back to lows and actually pushed below that June low, which is bearish for now. I do think at some point there will be another rally. You can see it also here on SPY. We did break below June lows. I do think that we might come down here to test this 340 level potentially, maybe 350. It really depends on what CPI release data shows on October 13th. There's a lot going on in the market. Everyone's bearish. I think at some point the market's going to find some sort of support and then rally to the upside. Now, if CPI data is hot and inflation is high, then the Fed has even less wiggle room now to, they'll have to continue to raise rates, and that would be bearish for equities. And I think that if for some reason CPI comes in really hot, then it's possible that we might push all the way down to this 320 level. Maybe potentially even around like 315, 320. All of these levels can be taken out because of how high VIX is right now, or volatility. You can see here that it's been building over time. This is what happened in March of 2020, but you can see that volatility has been elevated to around this 30 to 32 level. And if you look at the VIX over the long run, 12 to 15 is usually like a normal range. Anything above a 20 is around bear market level. So overall, there's a lot of people that are buying hedges thinking that the worst is coming. For small caps, we did have that bear flag breakdown and we retested the June low. We still are above it. I do expect at some point that we'll probably fall below it, most likely this upcoming week. As I talked about before, in between option expiration dates on each month and each quarter are important because it puts the market on rails. So derivatives are constantly being traded each month and there's an expiration date, but as price moves at maybe like say the first half of that period, that time period, then more and more options are going more in the money. People keep snowballing and there's like this gamma build that happens, this option driven equity flow that happens because the market participants, the market makers rather, are hedging against your position either by shorting sale shares or buying shares. And so because the market's in a bearish formation, you're actually seeing a lot more of this snowballing effect take place, either and as well because volatility is high, you'll have these large swings in the market. And I do think that in this market, it is a bear market. We'll continue to have these violent swings as we continue in this downtrend. And then tech, this was kind of interesting. We actually broke just below the lows in June. This was mainly driven by Apple. We did have that large swing down. What I talked about last week, that we'd likely break this 148 to 150 level. We did break below it. And then now we're at 138, which is a support level. So we might find some relief here, maybe the first couple of days of this trading week. But I do think at some point it's likely that we'll come down and also test that June low. Apple's just one of those ones that just hasn't sold yet. It's held price really, really well. Even if you we'll look at Google, we had these setups here. It broke out down on that flag, and it's just constantly gone down and down. I do think at some point it could even get down to this 85 to 86 level. I'm not currently in this position, but it's just something to note that you could have entered puts here or even at the top of the flag, which would have been an even better position because at this point you would have had a swing even greater to the downside, about 22% you could have captured on some put contracts. The first thing that I wanted to talk about really though is Tesla. So you can see here on my chart, it's kind of a mess. Even if you look back 800 days, the point of control here is all the way down at $52. So Tesla is still trading about 305% above its pre-COVID highs. So it's still really overvalued. Obviously, there was a lot of growth for this company. It's become more and more of a real company over the years. I will give it credit for that. There's a lot of people that want to buy and own Teslas. I don't like the car personally. I think it's really cheaply made, but to each their own. We just had really bad delivery numbers, about 14,000 less than forecast. And so that's like about 1.2 billion in revenue, give or take. And it just goes to show that autos in general in the industry are starting to show some weakness. And as you can see here, I think it will go back down to that 209 level. It also had that AI, whatever you want to call it, day. They rolled a robot out on wheels with like 5 people helping it out on the stage. It just looked awful. Overall, not a good look. We'll see how the market digests all that information on Monday, but I think it's most likely going to be to the downside, and we'll probably come down here and test that 208 level. I'm not in Tesla personally. It's just one of those stocks that doesn't like to give up, so it's really hard to play to the downside. It's always better to play a bounce. But what I am in is RIVN puts. We've talked about this before in my other videos. Each week we've been tracking this, and you can see here that it actually broke down below and then retested and held below on this bear flag. So we do think that given that Tesla is likely to struggle here in the next week or so, we think finally that this will probably start to push down to 24, probably all the way down to this 1925 level. And then like we have here on price, you can see that the top of the flag is right here, and where it breaks down, it's likely to come down and test that $10 level at some point. Now I do have March dated put contracts down to $20, so I've given myself plenty of time, plenty of room for price to actually move towards my strike price and for me to actually make a profit on those contracts. So that's something you always want to be looking at. Royal Caribbean, this is an interesting one. Obviously, cruise lines did really bad during COVID. They had a lot of support. The market rallied. It never quite broke above its pre-COVID highs just because of the lingering effects of COVID and people not wanting to go on cruise lines. We just recently had hurricanes in Florida. You can see here that there was a bear flag forming on Royal Caribbean. It even came back up and tested this 52 level. Didn't quite get up to where it broke down before on that low in March, but this area here, which it finally broke back down below, it broke below the flag. Carnival Cruise Lines did absolutely awful on its earnings. You can see here that it actually broke below its COVID lows, and so I think because of cruise lines, they have ballooning debt on their balance sheet. There's high fixed costs, high operating leverage in the business. It's likely that it's going to come down to this point of control around here at 35. I'm in 35 puts, strike price 35 for December. Just entered those on Thursday, and it's almost already in the money, so we'll see how that plays out. Still holding on to those. We already looked at Google. Let's look at Enphase. This is a company that a lot of people have been investing into. They think it's a safe space, just like the whole rotation into renewable energies. Obviously, you can see that the point of control is way down here at $22. Usually when something's that low, I don't really pay much attention to it. What I would look at rather is I can come here into my settings. Let's look back, just say 300 days. And you can see here that the point of control is closer to $180 a share, which is probably more likely what it's worth. We do have kind of an interesting setup here. You can see that it's ping-ponging between 272 to around 324. If you move this down a little bit, you can see that a lot of candles are kind of rejecting that area, as well as a lot of price support in this 273 level. Now, I do think at some point this is going to break below, and if it does, you can enter into a trade with a target around 225, which is like this previous breakout point back in July. And if I was going to enter into this trade, we can take a short position, have that price target right down there to that 225 level. We can set a stop loss. If it price bounces up to say 280, you can play some contracts out to January, maybe even longer if you want less risk, or even shorter if you want more risk. But overall, I do think that at some point that level will break, and if you get a daily close below it, you can enter into some contracts with a price target down to 225. When there's a breakout like this, there's not much volume, so you can see there's a gap in volume, and so price will move quickly. So if there's less volume, price moves quickly because there's less liquidity at those price ranges. It might try to fill it in a little bit, but I do think that ultimately, if price breaks below, it'll come down to this level in a hurry. Maybe it'll bounce, maybe it'll break down below, maybe it'll come back up. But overall, I do think at some point it's going to come back down to that 225 level. So watch out for that. Gamestop, this is one that we've been watching for quite some time. I still think I'm bearish to the downside. I'm really looking for this $10 level, and I have the play set here. You can set an alert and just keep an eye on it and just be patient. But once I do think it touches that level, we could have a 200, 300, 500% swing to the upside. If I was going to probably trade it, I would buy some really far out the money, far out in the future contracts, long dated contracts, maybe into May of next year. If it hit that level today, probably buy some calls around $30 to $40 to $50, just so that I can capture that return on a bounce, because I do think that it's a great technical level to play. Looking at Costco, this is one that we've been short for quite some time, starting in early August, and we finally had that breakdown. It came lower after its earnings, even though its earnings weren't all that bad. We still had that push down. Same thing with Procter & Gamble. So just like a lot of these consumer staples, you've been seeing this rotation out of it, and this is something that I've been calling for quite some time, that Costco likes to have these wild swings. And so you have these 30% plus swings either to the downside or the upside, and then it kind of repeats itself. And so this is a great stock to trade, and premiums are actually quite low, especially if you're playing put spreads or call spreads. This is just a great stock to trade overall. Lots of movement, and it's usually swinging from one end to the next over a few weeks or even months. Datadog, this is one that we're currently tracking. If you see here, this is very similar to what Google is set up, right? So you have this bear flag that's playing out. If it breaks below, then it's likely that we'll see a continuation pattern to the downside, but it quite hasn't really broken down as much as I would have liked it to. It is holding its own right here around $88, $89. You could set a position like so, that you think at some point it will make its trend down. To give you an idea of what price is, you take the high and low of the flag and then move it to the breakdown point, and you'll see that price is expected at some point to move down to $50. Now, there is also some support here around $72. And if we look at volume profile, let's see if that gives us any indication. If we look back even further, say 800 days. Oh, well, it won't show if there's not enough days, right? So let's do 700. It's still not enough. We'll do 500. Oh, actually, 700 was showing, I think. Yep. So you can see here that $72 range is probably a good place to take profit. So overall, that would be about a 20% move to the downside with relatively low risk, as long as you have that stop loss in place, that if it breaks back into this flag, you can exit out, because it might go all the way back up to the top of this flag or around 120, which is where it rejected before. So that's just something to look out for. And then lastly, let's take a look at GOGO. I hate this company. It's awful. You can see that its point of control is around $3. A lot of air below. If it breaks below around $10, there's not a lot of volume here between $8 to $4. So I do think at some point that $8 will be tested. If that breaks, then it's a quick rush down to $4. A lot of capitulation that will likely happen. I do think right now I'm in puts all the way through May, 11p strike, as well as 9 for January. So I do think that over the next several months here, because of what's going on in the macro environment, this is just one of those companies that people are going to sell first in their portfolio, and you're going to see this large move to the downside. This is a pretty easy setup to watch for. Well, that's it for this video. Hope you guys have an amazing day and stay safe out there. I'll see you next week.